Ladies and gentlemen, good day and welcome to the Cyient DLM Limited Q3 FY25 results conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krishna Bodanapu, Non-Executive Chairman, Cyient DLM Limited. Thank you, and over to you, sir.
Thank you very much, and good evening, ladies and gentlemen. I'm Krishna Bodanapu, Non-Executive Chairman of Cyient DLM. Welcome to Cyient DLM's earnings call for the quarter 3 of FY25. Present with me on this call are our Chief Executive Officer, Anthony Montalbano, and our Chief Financial Officer, Srinivas Kulkarni. Before I begin, I would like to mention that some of the statements made in today's call may be forward-looking in nature and may involve risks and uncertainties. A detailed statement in this regard is available in our investor update, which has been posted on our website. In the last quarter, we announced the acquisition of Altec Electronics, a leading EMS company based in Torrington, Connecticut in the U.S. The strategy behind this deal was clearly on leveraging synergy benefits. I'm excited to share an update that the process of integration is going exceptionally well and to plan. We're pleased to report our Q3 performance, including Altec Electronics this time. With the addition of the client base, the synergy conversations are increasing significantly, and I had the opportunity to have 3 synergy conversations last week when I was in the U.S. It is very encouraging to be a part of these discussions and expansion plans, and I'm confident that we will see the synergy revenue coming in the next quarters. The political developments in the U.S. are also going to be a significant opportunity since they create localization requirements, and Altec will benefit from these requirements. For those of you who heard his speech last night, President Trump was very aggressive in setting his intent of increasing manufacturing in the U.S. His industrial policies will be aimed at strengthening domestic manufacturing, and it is perceived as an opportunity by many OEMs and Tier 1s in the U.S. to manufacture locally, and they're already reaching out proactively to us to manage this growth, to manufacture components locally. The outcome will be several opportunities for Altec, and I'm very happy and I'm very glad that the leadership team was able to proactively identify an opportunity to create significant manufacturing capability in the U.S., and that is going to benefit us as President Trump's industrialization policies start to take shape, and all indications are that made in the U.S. will be a big part of that. On the other hand, our revenue mix is slowly changing, and this is having an impact on the medium term. We are looking at it positively to both on our profitability and cash flow. Having said that, some of the large contracts that we signed during last year are starting to see traction, and we see this further increasing in the coming quarters. We're also gearing up to make sure that we're able to meet these requirements. With the industrial and medical science showing recovery and clients of Altec looking at our manufacturing facilities in India for India requirements, I can assure you that the road looks quite, the future looks quite confident for us. And I am confident that we're headed in the right direction and getting ready for the next phase of growth. Now I will hand it over to Anthony and Srini to provide more updates on the business and finance in more detail. Anthony, over to you.
Great. Thank you, Krishna. So, as Krishna highlighted, Altec has been part of the business now for 1 quarter, and I thought it'd be important just to kind of highlight some of the key aspects of the business as well as the integration highlights in that regard. So, Altec has been providing services in the EMS industry, based in Connecticut, for about 50 years. Primary sectors for the business include industrial, medical, and defense. And this aligns with our current portfolio, allows us to expand and potentially take up ITAR programs into the U.S. defense sector market. It also provides some overall business diversity in terms of business sectors that we operate in, giving us a additional industrial and medical sector opportunities. The client proximity, a lot of our clients within Cyient DLM are Western-based clients, and there are many opportunities that are now available to us by having U.S. manufacturing available that were not part of the discussion earlier. This geographic footprint aspect of the business will create growth opportunities for us and also complements the additional client access that we would get as part of Altec's portfolio. The capabilities of the site are also very complementary, and the DNA of the business focusing on very high value, low volume, high mix, mission critical type of electronics are very complementary to the business that we've been operating under for many years, and allows our clients to have a similar experience whether they are working with us in India or in the U.S., as we now are providing global offerings. On the integration progress, there's been considerable focus on the go-to-market aspects of that. That includes integration of working with top key clients across both of our businesses, working with the go-to-market leaders that focus on these clients with both of our businesses. They're now integrated as we look at opportunities. We now collectively plan and execute on how to make those opportunities transform into business. The operations integration and HR integration aspects are also underway, and the first quarter that we will be providing a consolidated view as well. This is a reflection of that. Supply chain synergies are also being mapped right now. This brings certain aspects in terms of what we can do with certain key aspects in the supply chain part of the business that can include key components, distribution, overall spend we bring in certain aspects to help provide greater value that we can bring to our clients in that regard. And then also the financials have been integrated, and we'll be discussing some of those here going forward. Some key wins for this quarter. We secured one leading global technology company focused on the energy services and solutions space, which we would club under our industrial sector. This is a leading multinational OEM that we look to be a key growth and overall revenue client for us in the future. This is in addition to at least 6 new logos of similar scale that we've announced in earlier quarters. From a pipeline perspective, our pipeline is considerable with over $1 billion in TCV opportunities that we aggressively to try and convert. And also we are currently working on some specific large opportunities that are in advanced stages that we'll provide more updates on in the quarters. Some other aspects of the business from a recognition perspective, one of our largest customers this year, Bell has recognized us as a valued partner. Just another testament to the services we provide and quality in these types of applications. Also, some other aspects from on the business highlights. Focusing on our environmental and initiatives, we did announced a strategic partnership with Arcado for a basically a solar power plant that we've applied to our Mysore facility, which will is a key aspect to help our ongoing commitment to renewable energy. We've also received some awards, specific award from the state of Karnataka for overall export and business growth in that sector. So those are some of the key highlights for this quarter. Excuse me. I'll turn it over to Srinivas for some of the finance updates.
Thank you, Anthony. Thank you, ladies and gentlemen, for joining the call today. I'll walk you through the Q3 financials. This will be a consolidated financials for including analysts, and I'll also call out some of the key aspects of this particular quarter, which are, the one-off expenses we have incurred for concluding the M&A, right? And then we've sort of shown an adjusted EBITDA and a PAT number so that the sustainable performance becomes clear to you. But we've also showed what the reported numbers are in the comments. So to start with, we did a revenue of 444.2 crores, which is a 38.4% growth year on year. Now, this of course includes Altech's number as well, and the standalone revenue for the period was 357.3 crores, which is a growth of 11.3% year on year. From an EBITDA perspective, 359 million rupees is the adjusted EBITDA, which translates to a margin of 8.1%. Now, this is lower year on year by 109 basis points due to a few reasons, and we'll talk about that in detail. But the reported number is about 8 crores lower than this because of the one-off expenses we have incurred in terms of the banker fees and the lawyer fees, etc., that were used up to conclude the M&A transaction. Similarly, the Q3 reported PAT after adjusting for these expenses is about 108 million, but the correct number to look at, which is the adjusted number, is 106 million, which translates to 3.7% in percentage term, and also it's a degrowth year on year of about 10%. Order backlog now includes the Altech numbers, so this stands at 2,142.9 crores, and the number from Altech that is included in this is 291.5 crores. So the standalone order backlog is the difference between the two. Looking at some of the key KPI trends, and this again, the Q3, the latest numbers in this chart are all the consolidated numbers, which includes Altech numbers, and it just gives a trend for you in terms of how we have performed on the important metrics of revenue, EBITDA, and PAT over a period of time, over last several quarters. The non-P&L metrics, we will take a look at how we have done on the net working capital, right? In terms of DSO, we are at 76 days. This is a drop quarter on quarter as well as from a year on year as well, right? And there is improvement that we see in the DSO metrics. In DIO, we are at 129 days. Again, this is a little bit higher than last quarter, but we have a roadmap to get to about between 90 and 100 days, and we are still at a level which is slightly elevated more than where we would like to be. DPO has improved to about 69 days, and customer advances, as the nature of the business, has dropped to about 16 days in this quarter. As we consume some of the the revenue from the customers who have given advances, this number will continue to drop. We are not expecting any new advances in the near future. So this is something that we will see as a trend. And so all in all, the net working capital is about 120 days, which is an improvement from a previous quarter, as well as it's almost in line with where we were last year in the same quarter. And I'm also happy to report that at the consolidated company level, we've had free cash flow, which is positive for the quarter. Now, this slide gives a trend of the industry mix, the product categories, and the mix between the rest of the world and India revenue. Now, you will find this interesting in terms of the industry mix. This is significantly different from how we have shown in the past, right, in terms of being very heavy on aerospace and defense. Now you see a big chunk coming from industrial and medtech as well, and this was one of the reasons why we did the acquisition. It diversifies our industry base very nicely, and this has led to a growth of 47% YOY on industrial and about 166 on medical. Right. So this chart looks more balanced now with the acquisition of Altech. Now the mix of the PCBA, box build and cables has not changed significantly, but we continue to see a large portion of our business coming from PCBA, and the box build growth now stands at 16% year on year. Similarly, on the mix from between geography, now the Altech business is counted in the rest of the world, which is at 61%, and the India business is at 39%. And we will continue to watch this trend going forward as well. The chart just gives a tabular view of the financials we just reviewed. It has more granular details in terms of the various cost elements. I think you can go through it in detail. As you know, the financial footprint of a US company is different from an Indian EMS company. The ratio of material and employee costs is different there, and therefore you see some changes as we go forward. Right, the employee cost will be higher, material cost will be a little bit lower as we consolidate. The other thing you will see in the financials here is also the depreciation and amortization. As you know, when you make an acquisition, there is a purchase price allocation, and the intangibles start getting amortized over a period of time. That is discussed with the auditor. Now, this number is not really a cash expenditure. It is just allocation of the intangibles and write-off of the same. And so, with all of that, I think you see a profit which is adjusted and reported here for the quarter. And just to give further clarity on how those one-off expenses are treated between EBITDA and PAT, this slide gives you more color in terms of how we treated the M&A expenses as a one-time transaction related. This will not repeat going forward. So that's why it's called out as an exceptional item. Slide on the IPO proceeds utilization. As we had stated in the objects of the issue, we had earmarked 10% of the entire issue proceeds towards inorganic. So we've used that and a part of the general corporate proceeds to make the current acquisition. We've repaid all the external borrowings, and the trend on the working capital and capex is lower than what we had expected. We have used up only 135 crores so far, but we'll roughly use up about 190 crores by the end of the year, and we'll have another 100 crores left for the next financial year in terms of the working capital requirements. But on capex, we have excess capacity right now, so there is no need for a substantial expansion of capex at the moment, right? And so we have enough capacity to even run next year. There will be incremental capex additions during the year, and we will call that out as we use the funds towards capex. There are some more annexures as well in the presentation. I will not go through that right now. These give a better color on the difference between the standalone and the consolidated numbers. We also have a slide on the 9-month performance. Please go through those, and if you have any questions, we can address them. But with that, I conclude the finance presentation, and we can go to Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepak Krishnan from Kotak Institutional Equities. Please go ahead.
Hi, sir. Am I audible?
Sir, you are audible. You may proceed.
Yeah. So just wanted to check. So essentially, if we look at the order book number, adjusted for the 2,915 million, which is the Altech impact, we've again sort of seen an order book decline, comes to a number of 1,854 or somewhere close to that. So essentially, in terms of new order wins, we've indicated we are at final stages of negotiation. But when do we start, seeing large orders coming in? And plus, obviously, whatever comes from Altech, maybe just an outlook in terms of what is the U.S. growth that you're expecting for the next maybe 2 years, essentially because of all the potential impacts due to, the localization of manufacturing there.
Yeah, I think on the order backlog, right, I think we've seen from organic business, yes, we have seen a degrowth this quarter as well. The pace at which the large order from one of the key customers is being consumed is higher than where we are seeing the growth, right? So look, I mean, it's a little hard to call what the outlook will be. We are definitely working on several large opportunities. As Anthony also highlighted, the pipeline is large, right? And then there are several deals, and at least 3 large deals where there is active conversation at an advanced stage. So as those convert, I think we will see the order book growing up from where we are today. Altech has a shorter sales cycle compared to Cyient DLM, so they will fill a lot of orders even during the year. So if we start with let's say 90% visibility, they start with a 50-60% visibility, just to give some perspective of how that business runs, right? And definitely we see a growth in North America. I think for 2 reasons. One with the acquisition, I think it gives us a footprint of having manufacturing presence in North America, which and a lot of clients have been demanding the sort of proximity to their centers. Another is what Krishna mentioned. Just the sort of political changes that have happened in the US and the outlook that is there in terms of keeping America first and manufacturing in the US. I think we will definitely see much higher growth in North America compared to what we've seen in the past.
Sure. Maybe just a second question. If I just, look at the difference between the standalone and the ConCall and adjust for the 80 million sort of one-off expense, I think Altech this quarter reported an EBITDA margin of closer to 7.6 versus, standalone about 8.3 prior to other income. So is Altech EBITDA margins, more in the 7 to 8% range, or do we also see that this segment can potentially help us get to, 10% EBITDA margin that we've indicated that, that's sort of a stated goal that we want to reach out?
Yeah. So first of all, the Altech's EBITDA margins are similar to ours in this particular quarter, right? But they have a roadmap for getting to about 10% at least. And then even when the acquisition was made and we've seen the historical performance, I think they have operated at around 10%. We have a few expenses which are sort of, just immediately after the acquisition that have taken place this quarter. But we have a clear line of sight to get to 10% on a sustainable basis in Altech.
Maybe just wanted to understand, sort of, do we still stand by the 30% CAGR guideline for a 3-year time frame, and any particular, revenue guidance that you want to give for this particular year, given that organic growth this quarter has slowed down to about 11%. So just wanted to sort of understand these 2 points.
Yeah, regarding the 30% figure that we've discussed, that's just been more of a guidance, as more of a CAGR year on year. I think you're going to find some variability. I think the first year we delivered over 40%. Then we find I think we delivered in the 20s, and so that's going to vary. I think that is still a healthy number to consider on just the mid to long term of our business. But as we look at certain programs transferring out, and as we ramp other businesses up, there definitely could be some lag on years in that number. So it's not meant to be a firm 30% year-on-year guidance.
Sure, sir. And we just wanted to understand the strong free cash flow generation that we had this quarter. Given that there was only, slight decrease in net working capital days, anything else that sort of aided this 478 million of free cash generation, because it's only about a 7-day decline QOQ in NWC?
can you please repeat that question?
Yeah, just wanted to understand the 478 million of free cash that we've generated this quarter, because working capital has not really changed that much. It's gone from 127 to 120 days. So any other factor that led to such a strong free cash generation?
No, I mean, the release of working capital is significant. Even though it looks like 7 days, I think that does translate to a big number, right? So you will see the 47 crore is also includes some of the cash generation that is coming from Altech. But yeah, I mean, that 7-day release is a big number, right? And that does translate to the number.
Yeah, maybe just a final question from my end. Wanted to understand, last quarter we had an FX loss. This quarter we had an FX gain, but, net the other income has not really jumped. So any other factors that's sort of causing the other income to be lower this particular quarter?
No, I think there are two aspects. I think that also has an aspect of the sort of the interest yield on the deposits that we have, right? I think even that number may have come down in the current quarter. I don't have the specific number in front of me, but yes, that also has a bearing. We don't see other income going up because of the interest yield on as we consume the cash from the IPO. I think that number is going to sort of shrink, right? Unless we have surplus cash and start generating interest income, that number will go down. So, and exchange fluctuation impact will be there. There will be realized and unrealized gain both coming up in the other income. And that's something we can't really predict.
Sure, sir. Those are my questions, and best of luck for future quarters.
Thank you. Ladies and gentlemen, in order that the management is able to address questions from all participants in the queue, you are requested to please restrict your questions to 3 per participant. For follow-up questions, you may rejoin the queue. We have the next question from the line of Vipraw Srivastava from Phillip Capital. Please go ahead.
Hi, sir. I'm audible, right?
Yes.
You are audible, sir. Please go ahead.
Yeah. Firstly, on the standalone margin, why other expenses as a percentage of sales relatively higher? Because revenue has degrown QOQ, but other expenses gone up. So any thoughts on that?
Yeah, so the other expense this time includes the other expenses of Altech, right? And like I said, I think the financial footprint, while at EBITDA level the businesses are comparable, I think the mix between the two businesses are different.
I know on the standalone level I'm talking, sir. There you don't have Altech, right?
Yeah, on standalone level, there are a few operational expenses that have gone up this time, namely the sort of the bad debt provisions and some of the other provisions that we have taken in the business. That's more on we now take the provisions on an expected credit loss, which is basically on the aging of receivables. Some of our receivables have moved to the right, which as per policy we have to take it. This is recoverable next quarter as we collect those amounts. But for the quarter, we have taken a conservative view and provided as per the policy.
So what would be the quantum of the receivable number? If you can give 8 crores, that's the number.
What is it? Sorry. What is the number you wanted?
What's the quantum of that expected credit loss you have taken in receivables?
No, I'll not quantify that separately.
Okay. Sure, sir. Sure. So, I mean, on a gross margin level, you have maintained a gross margin. That's commendable. But going forward, how do you see your EBITDA shaping up? I mean, this quarter we were expecting EBITDA to ramp up, but again, because of this other expense, it has again come down. So how do you see EBITDA progressing in coming quarters?
Yeah, so the mix of the business has a big bearing. We've discussed this in the past as well. As we get into Q4, I think the one large deal, which is slightly a drag on the margins, is going to ramp down significantly, right? And therefore, I think our margins will improve in Q4 and beyond. So you will see substantial improvement in the margin for the Q4 quarter.
Right. Fair enough, sir. And so on a standalone level, they've only grown at 11%. So, I mean, this order book you were mentioning, a few large deals you are in discussions with, what will be the quantum of these orders? I mean, will they be big enough to move the needle on a console level? I mean, anything on that? Any quantum you can give? Rough quantum, anything on that?
Yeah, these programs do have impact on our next 2 fiscal years, and so definitely some on FY26. and they really are dependent on a couple of these are transfer programs and a couple other programs. So there is some variability there as to how fast they come in, but again, we do see the impact on these deals, starting in next fiscal year.
So you are saying by FY26 we see these converting into full-time orders, right?
Yes, we will definitely start to recognize them as part of our backlog as soon as we get those closed, and then as far as impacting the revenue and all the other aspects of it, that would come in the quarters following.
Right. And question for Srini. Sir, I mean, obviously you mentioned about the ECL, express credit loss on receivables, which resulted in higher other expense. But, I mean, going forward, do we see such a surprise? Because is it a one-time thing, or is there further receivables which can have ECL in future? What are your thoughts on that?
No, this is a one-off thing. I think we've had some of the receivables not getting collected during the December quarter, owing to holidays and a few other factors like that. Definitely one-off thing. We will see substantial improvement going forward. And also, the provision that we have created is more on a sort of this quarter on a conservative basis, as we just do not want to deviate from the right. But as we collect, we are confident of collecting those, right? We will see. And long-term basis, right? I think the ECL, accounting standard is you show efficiency in your collections, the provision automatically goes down, right? So so we will obviously, as we target our DSO to be between 60 and 70 days, it's currently at 85 days. I think we will start seeing that improve.
Right. And sir, last question. This ECL is from a foreign client or domestic client?
It's from the domestic client.
Okay, sir. Thank you. Thanks a lot.
Thank you. The next question is from the line of Arafat Syed from InCred Research. Please go ahead.
Yeah. Hi, sir. Thanks for taking a question. So my first question is on your order book. Let's say despite adding Alltech on your order book, it still takes towards more about the defense and aerospace, around 66-68%. So in the future, you expect this should go more about the medical industry, or this will remain as it is on this?
So if I understood the question correctly, I think you're asking regarding which business sectors the order book is aligned toward. We do see, if I got that correct, we do continue to see strong aero and defense as part of that order book. That being said, we also have that still is more dominant, but we still do have some new opportunities in this regard that will impact our medical and industrial as well.
And sir, the second question is on your recently you order from Honeywell, and that is for 15 years.
You do sound a little muffled on your line. We request you to please check the mode that you're using on your handset.
Yeah. Hi. Now, audible now?
Yes, it's slightly better, sir. Please go ahead.
Yeah. So my question is on your order book, which you recently got from Honeywell, order inflow of around $50 million. That's for 15 years. So what is the status of that, sir? Have you executed anything on that, or this will remain, let's say, in the long term only?
Yeah, regardless of that deal, that's a very strategic opportunity that we've commented on and are planning to continue to support that. Regarding getting into more specifics of that would compromise client information in that regard.
Okay, fine, sir. That's it on my side.
Great. Thank you.
Thank you. The next question is from the line of Deval Shah from RBSA Investment Managers. Please go ahead.
Hello. Good afternoon. Am I audible?
You are audible, sir. You may proceed.
Yeah. So it's more of a clarification first. So what I understood is that the margin profile of Alltech is very much similar to Cyient DLM. And Alltech as well as we both are aspiring to go for 10% margin. So is my understanding correct?
No, Alltech is already at around 10%. This is a one-off quarter, right? I think we should also look at these businesses on a full year basis, not on one quarter. Quarters have some seasonalities in the cost, etc. On an annual basis, I can assure you that Alltech is more like a 10% business.
Okay. So that's what my understanding. So I was also asking for the full year basis only, not on the quarter basis. So if the margin profile of Alltech is very much similar to what Cyient DLM is aspiring. So we are also aspiring for the 10% margin, right?
Yes. See, we will also end with a higher margin on a full year basis this year as well. And 10% is just the starting. It's one milestone. It's not something that stops at 10%, right? I think our aspiration is bigger than that. But I think the first milestone for us is to consistently deliver 10% and then grow from that point on.
Okay, fair enough. And my next question is to Krishna. So while he alluded about the US opportunity for Alltech, which is a good deal for us, just wanted to understand how the Alltech business in the EMS is different from Cyient DLM's what are doing it right now. So how the return profile are different. So if I want to break it down the ROE, so how is it different? So what is the Alltech's ROE looks and Cyient DLM's?
So I think from a ROE perspective, both businesses will end up being quite similar. If you look at the advantage that Alltech brings, two things, right? One is Alltech works in some very sophisticated sectors like industrial, safety critical industrial or safety critical medical, which is a complement to what Cyient DLM does. Because of course, we do some work in those sectors, but a significant portion of our work is also concentrated in aerospace and defense. So the first element of what Alltech brings to the table is some very sophisticated work in these safety critical industrial and medical sectors. The second thing is the defense angle that Alltech brings to the table. Now, by law, anything manufactured for U.S. defense has to be made in the U.S., which means that so far, while we've had some big customers, and as you know, in the wider Cyient ecosystem, aerospace and defense is a critical industry, and we work with pretty much all the large aerospace OEMs who also happen to be defense OEMs. We're now seeing manufacturing opportunities from these customers because they also need equipment to be made in the U.S. We already do a lot of design in the U.S., as you know, in Cyient, but now we can also make in the U.S. So in that sense, the Alltech business is a great complement to the Cyient DLM business. And it's again, I'd say complement, not supplement, in the sense that it is it's very unique, it's very adjacent. And therefore, we believe that there's a good growth opportunity. Again, from a metrics perspective, over a period of time, we believe that both from a margin perspective, ROC perspective, and cash generation perspective, by the nature of the businesses, both will be very similar.
Okay. Thank you. All the best.
Thank you. The next question is from the line of Jinesh Shah from RSPN Ventures. Please go ahead.
Yeah, hello. Am I audible?
Yes, you're audible, sir.
Okay. So my first question was, I think the previous participant already asked. So I just wanted to understand that we have a couple of one-off expenses like ECL provision for debt, debts, and M&A expenses in this quarter. So it will be helpful for me if you will be able to quantify accumulatively that amount.
No, look, it will not be fair to call out specific amounts like that. What I'll tell is these are one-offs and they will not repeat, right? I think on the M&A, we've already quantified that this is an 8 crore expenditure, right? Because it was very straightforward, it was a few line item. But and then some of the other operating expenses have gone up this quarter. They will not repeat in Q4, and the other operating expenses have not been called out as one-offs. So what you will see is the operating performance itself showing a better number next quarter. But from an Alltech's perspective or the M&A integration perspective, there is a one-off cost that was incurred, and that has been called.
Okay, fair enough. So, as you mentioned in last call that overall margin for the entire year should be flat as compared to the previous year. So if I take consideration the hit of this quarter, then for this quarter at least we'll be doing a little bit less, we'll be earning little bit less margin than 9 to 9.5%, right? Then we'll be able to try to achieve milestone of 10% probably in the next year. That's what the outlook is from your end?
Yeah, I mean, as I mentioned, I think the margin has several factors, right, which is take into account. The business mix is one of the largest factors that influences the margin. Now, when you look at our current business mix, it has a certain mix of low margin business, which is going to drop in Q4 and further substantially drop in Q1. Okay, so both these lead to better margins in quarter 4, leading to a full year margin being it's closer to being flat year on year in margin terms. But the exit quarter for the current year in margin terms will be good, right? Which will argue well for the next year, that is the next financial year as we go into it. Of course, there is another factor to consider here, that the first half of next financial year may not be high on growth, right? It will be a softish first half, given where we are in terms of our overall order book and the large order coming down. So there might be some absorption impact, etc., that we will see in the first half of next year. But having said that, overall, from a full year perspective, the margin is likely to improve from where we are today, and the first demonstration of that will be in Q4.
Okay, understood, got it. And my last question would be if you can talk about the macroeconomic environment, like do you anticipate any headwinds across, based on the talks with the customers or the opportunities that you see in the market? If you can talk a little bit more about that in couple of 1 or 2 years, you can see.
Yeah, it's an important question. This is something that we talked, to all our top clients about on kind of what we're seeing and what they're seeing. So, on one aspect, if you look at our, top, if you take the one large contract that will be completed next quarter, if you kind of take that one out of the equation and you look at, really our top 3-4 clients, we've seen pretty strong, favorable outlook. In that regard, those tend to be a little bit more aero and defense focused. But then as you go down from there and start getting into the following clients that follow those, it's a little bit more of a mixed feedback. We're seeing some softness in certain areas there from some clients. Specifically in the industrial and medical segment, and then so it does get a little bit more mixed there. It's not that they're guiding down, but I think it's just client by client outside of aero and defense. So this is something we do have our thumb on the pulse on, and outside of aero and defense, it gets a little bit more mixed.
Okay, got it. That's it from my side. Thanks a lot.
Thank you.
Thank you. We have the next question from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Hi, thanks for giving the opportunity. I wanted to understand this difference between ConCall and standalone. Is that difference completely attributable to Alltech, or is there any other subsidiary where the numbers will also go?
No, it's completely attributable to Alltech, Mihir. So the standalone means the traditional Cyient business, which we have been reporting till last quarter. The consolidated numbers just include that.
Okay, sure. Understood. Second question was on this order book. Now this is like almost 7-8 quarters we have seen order book remaining largely flat or going down. I wanted to understand, what is the reason that the discussions are not fructifying into order booking? Because the pipeline has remained over that number, $1 billion kind of a number. But why is it not converting into order book? Some color on that will be helpful.
Yeah, I think one key aspect is that we have been consuming the backlog, and so as the orders come in, you kind of have to try and offset that. But these programs as well are they are larger, longer term programs. The award on them can shift in terms of timing. They can even shift a quarter or maybe even more time. But we also have announced some large contracts as well in prior quarters. So I think it's just more of a timing issue as those orders come in. It's just the nature of those types of programs, especially on the A&D side. I think you'll find a little bit more consistency when you start to look at medical and industrial, similar to the profile that was highlighted earlier, where that business would have kind of a quicker churn on the deals and on the business compared to the other sectors.
No, sure. I understand that, this is a lumpy business. It becomes difficult to guess it from a quarter-to-quarter perspective. But I mean, is it the case that the client has decided to defer this program, or is he evaluating an alternate vendor, or is the rate negotiation going on, or are the supply chain issues there which are resulting into these problems? So what exactly is it leading to, because these are lumpy orders, I understand, but there should be some specific reason around it.
I don't think there's really a specific reason. I think it really comes down to, there are several deals that we are working, and, we're not going to win all of them, but we have announced the ones that we have closed, and we do plan to close more. There can be various considerations as to why one may or may not come our way. But I would not try and categorize any specific trend or anything in that regard. We're our clients, really aligned to us on these types of programs based on our capability and strong track record we have in these sectors with these leading clients.
Sure. This number of 2,142 crores, does it include the aircraft tooling technology, contract which is there, which you declared on 5th or 6th of November? Does this number include that, or it doesn't include?
I don't think it includes this.
Okay, sure. And what would be the value of this deal? Because it's like a 16-year deal. At least the press release mentions that. So is it a large contract or it is not a large contract?
Which program are you referring to, just to clarify?
Yeah, this is the aircraft tooling technology. A press release you have given on 6th of November.
It's a large OEM.
Sorry?
It's a large OEM.
Oh, yeah, sure. So it's a large OEM firm, very true. But for you, is it a large contract or it is not a large contract?
No, it's a large award, right? So we don't have so from a total contract value perspective, that value is high. We have not received specific purchase orders which are large yet. As you know, I think the cycles are very long in this industry. You have to get to the NPI and then get to the main production. But once you are there, you will get that order. But right now, we are not counting any significant deal from that program into our order book. As they come in, we will see contract. But the award letter is there, and that quantifies the total contract potential for that order.
Okay, understood. Sure. Second question was just on the depreciation side. We are paying roughly $30 million for this acquisition. So what would be attributable to goodwill, customer purchase, and how to read the incremental depreciation? I believe the incremental depreciation is close to 4 to 5 crores, right? So should we take this as a ballpark number for the coming quarters as well?
Yeah, look, I think we will report the balance sheet next quarter. That's the balance sheet reporting period, and we are still going through the purchase price allocation process. But approximately, we will have $1 million every year coming in from the additional amortization, and the remaining will be goodwill. As you know, in manufacturing companies, the sort of inventory and other assets that come along with an acquisition are high. The goodwill tends to be low, right? And that we are in line with the rest of the acquisitions that happen in this industry, right? So we will have a goodwill which is substantially lower than the purchase price we paid. So it also means the amortization might be a little bit higher. So if you net out the amortization, even with that amortization, it's a PAT accretive deal on a full year basis, right? So therefore, from the financial perspective, it's a good acquisition. But if you frankly net out the amortization, it's an extremely good deal, right? And it's not a cash expenditure; it's just the reporting. And so we are okay with whatever the purchase price allocation lens will say.
Okay, sure. And just one last question on the order book side. I mean, let's assume if our order book goes up in first quarter, does it translate to higher revenue in second quarter itself, or will that take time?
Again, specific to the industry where I think it's very hard to sort of quantify and say, which order converts how fast, right? I think in certain industries and with certain clients, it's a very quick turnaround. I think there are orders where the conversion is less than 3 months also. But in most of the A&T contracts, these tend to be longer. I think the order comes in, and by the time you see a meaningful revenue, it's at least 9 to 12 months. So it's hard to generalize and answer that question. So it's very client specific and industry specific.
Sure. That's it from my side. Thank you very much.
Thank you. The next question is from the line of Deepak Lalwani from Unifi Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. So in the standalone business, you've only grown by 11%. So what's the reason for the execution being low, despite, H2 being the seasonally stronger quarter? So any reason for this? And how are we looking at Q4, that is this Jan to March quarter, in terms of execution?
Yeah, one key element is we did have one top key client did have inventory that had built, and that caused a reduction in demand. So that did provide some of this. And then it comes down as well to just when you look at the overall mix of the program, as we have a very large percentage of our growth coming from a key program that we've been executing over the last several quarters, providing the new business to offset that. Those programs ramp at different rates. But again, one big part was a reduction in that one top program.
Sure. So has it issue of inventory been solved, and how are we looking at Q4 execution?
So we do that is being worked through, and again, we do expect demand there to return in the coming quarters, and again, that's specific to end markets of that client. And again, it's very much in line as well with kind of the industry sector outlook I gave earlier, kind of where we're seeing some strength and where we're seeing some mixed results.
Okay. And so if we look at the standalone order book, it stands at about 1850 crores. So what is the execution timeline for this? And if you can tell us what should one work with for the next year's revenue?
So the execution timeline is between 18 and 24 months, depending on client-specific needs and scheduling. We are still undergoing the budgeting process for next year, so we have no commentary on next year's number. So I think we will revisit this question at the end of next quarter.
Sure. Got it. And so this delay in order book, I understand, the client, understand the capability and will come. So, but is there any specific, reason for this with regards to the end user industry having some issues or any macro headwinds, mentioned in the previous comments also? If you can give more granular sense on it, that will be helpful.
I think it'd be difficult to start to give much bigger trends when you look at if you're looking at a large part of your business coming from 10, 12 clients. It's kind of hard to start to draw trends in that regard. So I think the level of response I gave earlier is probably the best guidance that we can give. Otherwise, it starts to become really speculation on just probably not enough data points.
Sure. So these three large deals that you're talking about, what are the milestones that are pending to, fructify these deals into conversions? What are the milestones left? And if you can just indicate broadly, what would the quantum of these deals be? Will it be in a 500 crore range, or will it be smaller deals worth 200 crore? Just a ballpark number would be helpful.
Yeah, so it's a typical sales cycle, aspects associated with the deal. It could be finalizing, it could be finalized pricing. It could be further, negotiations. It could be various aspects of the business award. So it's all these types of factors kind of come in. There's no really, one or two clean answers there. And then as far as, just the specific value of the deal, those we really try and limit providing those types of specific numbers. Again, just for client data integrity and setting appropriate expectations.
Sure. Okay. Thank you, sir. Those are my questions.
Thank you.
Thank you. Ladies and gentlemen, we will now take one last question, which will be from the line of Praveen Sahay from Prabhudas Lilladher Capital. Please go ahead.
Thank you for taking my question. My first question is related to the current order book. Can you give clarify that you had given one that 9 to 12 months execution timeline or 18 to 24 months execution timeline?
No, 9 to 12 is the execution timeline of a new PO. When a new PO comes on board, by the time, I would say when a new prospect, I would not even say PO. From PO to revenue, it's a shorter cycle. But from when a new client comes on board and you win an award, by the time it converts to meaningful revenue, it will be 9 to 12 months. The execution cycle on the order backlog is different. That is more on the current order. The scheduling between the 2 years is what is 18 to 24 months.
Okay. Got it. The next question is related to the LTEC. And as you had mentioned that, the consolidated and the standalone difference is only LTEC. So LTEC have a very high gross margin, that's in the range of around 45-46%. Is it, or is something different?
No, it is not that high. You may be referring to the contribution margin. Their gross margins are definitely higher, more in the 18-19% range when you take the other direct cost as well. But their SG&A also will be higher. So it's a different kind of a business. Right? That's what I said. While at the EBITDA level, the businesses are comparable. Some of the optics between the line items between, let's say, material and labor, etc., are different there in that business. So I think it's best to look at EBITDA level because there are also definition issues between companies here, right, and how they classify it. So.
Okay. And second clarification on the ECL. In the previously also you had accounted such kind of incidences in the business?
No, this not in the recent past. I'm sure there have been some instances in the long history of the company, but not in the recent past, not at least for the last 24 months, where there has been a substantial increase in the ECL. So, like I said, a one-off event for this quarter, it will correct for itself next month.
So actually, I'm trying to understand what is the probability of, as you had also mentioned, it's in the coming quarters, it's also get added back. So what is the probability of that actually?
No, the probability is extremely high. That's the reason why I'm confidently telling you that this is one of them.
Mm-hmm. Okay. And last clarification on the segment, that A&D, I believe, have a very high margin as compared to, the other industrial or railway. Is it understanding right?
Not necessarily. The sectors between A&D, medical and industrial, at least in the sectors at least within our client base, we actually find very similar margins. The variability is really more client specific or program specific. But as far as if you're to generalize new business in any one of these three sectors, they actually deliver very similar profit margins for us.
Okay, fine. And last clarification related to your three large deals which you are in talk. Those are domestic or rest of the world?
More rest of the world. I think the three we've called out are more rest of the world. There are definitely quite a few domestic opportunities that we are working, but I don't know if we would necessarily highlight those as a standout large deal. But there's definitely more of those that we'll be announcing later, but not necessarily the three that we chose to highlight for this quarter.
Okay. Thank you for answering my question. All the best.
Thank you.
Thank you. I would now like to hand the conference over to Mr. Krishna Bodanapu for closing comments. Over to you, sir.
Thank you very much, and thank you everybody for participating in the Q3 conference call. As you see, things are going okay. Things are going well in many cases. There are areas that we need to improve in others, but overall, I would say we are executing to a plan, which we feel very confident about. I'm very excited for what the business holds, and I also want to compliment the Cyient DLM leadership team on identifying, acquiring, and now integrating the Altech opportunity. We are one of the few, if not one of the only one EMS company in the world that has this capability, especially at our scale, which is essentially to do safety-critical, highly reliable, highly complex engineering-centric electronics from India, from the US, and we will, of course, further de-risk or further expand on our manufacturing base to create a truly global EMS. I think there are two elements to that we're working on. One is a truly global EMS capability, and secondly, a truly integrated design and manufacturing capability. It is hard work, but I think I'm incredibly proud of the team for the work that they're doing, and I think you will continue to see the results. Obviously, many great things have happened this quarter, and things will continue to get much, much better. So I'm very excited for the business. Thank you for the support, and if there's any further questions, I'm sure Srini will be happy to answer them. Otherwise, we'll speak next week, next quarter, sorry. Obviously, as you can tell, I'm very excited to speak next week, but thank you very much.
Thank you. On behalf of Cyient DLM Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.